Welcome back to another episode of Money with Ben, where you learn to manage your money with confidence. My name's Ben, and in this episode, we're going to be talking about operational risk, which is basically how risky is your company in regards to how it runs its business. And the formula that we're going to be using is called the operating leverage formula. And once again, we're going to be using Apple as our company to use this example. In the previous episodes of Money with Ben, we talked about risk a little bit, but it was on the balance sheet. It was in the video where we talked about the debt to assets ratio. We'll be sure to put a link in the description to that video so that way you can see it if you are not familiar with it. And it was basically asking the question, is your company solvent? Which was basically the idea of, does your company have the ability to pay its long-term financial obligations? In other words, can it pay off all of its debt if something bad were to happen? And we used a McDonald's as an example. That was on the balance sheet side. We could see how risky a company was when we were looking at the balance sheet. But with this formula, we can determine if there's any risk that you are taking on the income statement side. So basically on the operations side of the business, because the income statement is all about how well are you running your company. That's what we talked about in the previous episode about efficiency. Now I have a financial statement for Apple written down here. If you see me looking down, that's going to be the reason. And this P&L that I want to show you has Apple's net income, its revenue, and all of its expenses denominated in millions, but I'm going to be saying them in thousands. So for example, when I say that the net income for Apple on September 30th of 2023 is $96,995, it's really $96,995,000,000. They're Apple. All right. They have made a lot of products that I use, like the one I'm using to record myself right now. It's an iPhone 12. I'm trying to be efficient. iPhone 12, iPhone 14, they're gonna give me the same video no matter what. We talked about that in the previous episode, so just letting you know, I practice what I preach, okay? The way to determine the operational risk in a company is with this operating leverage formula. And the way that you calculate this formula is the gross margin, which is the gross revenue minus their cost of goods sold or their cost of sales, and that gross margin divided by their total fixed expenses. In many cases, the fixed expenses for a company is going to be their operating expenses, such as their research and development and their SG&A, or what we call the selling, general, and administrative, or we shorten it to SG&A because we accountants, we love our acronyms. You'll see. So it's once again the gross margin divided by the fixed costs or the fixed expenses. And let me go back into explaining the different types of expenses that we can incur. We talked about this in a previous episode. I believe it was episode 3, where we talked about the profit and loss statement. But remember, there's two types of expenses. There's direct expenses, and then there's indirect expenses. Direct expenses simply means that if you make more of a product or provide more of a service, direct expenses will go up or down in the same relationship. So if you make more revenue, you will have more direct expenses. If you make less revenue, you will have less direct expenses. It's a direct relationship that they have with each other. If one goes up, the other goes up. If one goes down, the other goes down. When you're in a product-based business, cost of goods sold is going to be one of those direct expenses. Why? Let's take Apple, for example. They sell iPhones. They sell iPads, but we're just going to use iPhones. They sell iPhones. And in order to sell iPhones, they need to make iPhones. So if they want to sell more iPhones, they have to create, they have to buy, they have to manufacture more iPhones. It just makes sense. So if we see iPhone sales go up, you better see their cost of goods sold go up as well. Cost of goods sold is basically how much does it cost to make their product, or how much did it cost to provide their service. Fixed costs or fixed expenses, these are indirect expenses because they do not have a direct relationship with your revenue. The best example that I can give is an accounting expense. Like, for example, if you hire me, I'm an accountant. My fee does not go up or down based on how well your company does. Let's say, for example, you run a small business and you hire my firm, and my firm charges $1,000 for a particular period. If you make $300,000 in revenue, my fee's still $1,000. If you make $50 in revenue, my fee is still $1,000. It's an indirect relationship to your revenue. And that's important to know, because if we're looking at direct expenses and indirect expenses, direct expenses are less risky, because when you are selling less or when you're making less revenue, you don't have to worry about paying more in direct expenses, because direct expenses are going to go down with your revenue. So it kind of balances each other out. You don't have to worry so much of thinking to yourself, oh man, am I going to have enough to pay for all these iPhones that I made? No, because if you can only sell 10 iPhones, you're not going to create 10 million iPhones. You're just going to create 10. So it's very less risky. However, fixed expenses, indirect expenses, operating expenses, these are all the same name. They are much riskier. Since they don't have that direct relationship, you better make sure that you are making as much revenue as possible, because if you make less money in a given year, guess what? Those expenses don't go away. Just like in your personal life. Let's take a step back away from business and just look at your personal life. My goal for each and one of you guys is to make as much money as possible so that way you can pay for your indirect expenses. What are some indirect expenses you might have? Mortgage payment, rent, utilities, internet, subscriptions. They don't care how much money you make. They don't care if you make more money one year or less money the next year. They're still going to charge you the exact same amount. And so that becomes very risky, especially when you start seeing your income going down. But what we always want to make sure is we want to have that number going up. If we want our company to be less risky, we need to have less indirect expenses. That makes sense. Less indirect expenses, less risk. The way that you calculate this, once again, gross margin, which is just revenue minus your direct expenses divided by your fixed expenses. All right, so let's take a look at Apple. Let's start in September 25th of 2021. Their gross margin was $152,836. Their operating expenses was $43,887. So if you take $152,836, divide that by $43,887, you get a number of 3.48 if you round to the nearest 100th place. We typically don't have this as a percentage. We just have it as a regular number, and we just round to 2 decimal points. 3.48 is the number of operating leverage or operating risk that they have. What this formula is telling us is for every $1 that they have in fixed, indirect, risky expenses, they have $3.48 left over after paying their direct expenses to cover their fixed expenses. This is an incredible number. This is a really good number to have because it shows that they have enough money left over after paying their direct expenses to take care of all those risky expenses that they may have in the future. When you see this formula, you want to make sure that this number is as high as you can be. It can depend on the industry that you're in. There are some industries that have a lot more fixed expenses compared to other industries. But overall, you want to make this number as high as you can. But let's take a look at if we go to the next years with Apple. Then we have gross revenue of $170,782, operating expenses of $51,345, Divide those numbers, you get 3.33. Uh-oh, it's slightly less than 3.48. And you apply the same formula to the gross margin and the operating expenses for September 30th of 2023, you're getting 3.08. So you're noticing their operating leverage number is getting smaller every single year. That's typically a sign that they're getting riskier and riskier. Something's happening in where either they're not creating enough revenue to catch up with their risky expenses as time goes by. Either their revenue's not catching up or their risky indirect expenses are getting away from them or getting a little bit more out of their control every single year. So we want to make sure that this number is getting higher. This formula is getting higher, not lower. If we know that indirect expenses are riskier, I'm going to repeat myself from the previous episode. The best way that you can avoid having these risky expenses is by, once again, stop buying stuff you don't need. Don't buy expenses that you can't handle. Don't buy expenses that you can't afford. And especially if the only reason you are incurring those costs is just so you can look good. Remember, you're not in the business of looking good. You're in the business of doing business, all right? For example, right now, one of the expenses that I have is this iPhone. That's one of the expenses I have for my company. This is a fixed expense because no matter how much money I'm making as a CPA, this iPhone is going to cost the exact same amount whether I do good in my business or not. So I want to make sure that I'm lowering my risk. And the good news, an iPhone 12, like the one I'm using right now, does the same job of recording a video as an iPhone 14 or an iPhone 15 or an iPhone 26, whenever that shows up in the next 2 weeks. But overall, it does the same job for me. Using a more affordable iPhone, I just mitigated my risk because I used less of an indirect expense. When I'm running a company, when I'm running my accounting firm, I'm going to be using software, I'm going to be using labor, I'm going to be using all the different types of subscriptions, dues, professional fees. I'm going to make them as affordable and as least costly to my business as possible because I know those are the riskiest things. You might have some expenses that may not make you look prestigious. You might have vehicles that look a little rundown. You might have some labor you might have to outsource. There are many companies that they have to outsource in order to make sure that they get their job done. Or they have to get their raw materials from a place that they can more easily afford. The goal is to lower your operating risk. And I'm not advocating making a cheaper quality product or cheaper quality service, but we as business owners, you as business owners, need to be more conscious about finding better ways to more efficiently run your company, because those fixed expenses are going to be staying with you no matter what happens to you, whether you do good or you do bad. So my hope for you is that those fixed expenses, those operating expenses, stay as small as possible. I hope you were able to find this video helpful and that you were able to learn that it's very important to have the least amount of risk in your business as possible and to only incur costs that you need, that you can handle, and that you can afford, so that you can run your business more efficiently and so you can manage your money with confidence. Until next time, this has been Money with Ben. My name's Ben, and I'll see you next time.